Hello everyone and welcome back to the channel. It's been a long time since we met. Since past 2 years, the inflation has been through the roof and the rate of fixed deposits are continuously decreasing. So if there is a huge gap between the inflation rate and the rate of return of your investment, instead of creating wealth, you are losing it. Public sector banks are a relatively secured option for investment, but is that investment worth it if it's only going to give you 5 to 5.5% of return in the next 3 years? In today's video, I will discuss hybrid mutual funds, which are currently the best alternative available for long-term fixed deposits. Before starting off on the topic, let's have a look at upcoming 3 years return on FDR. As you can see in the chart that the average return is just 5.12%. If we assume a tax rate of 30% on income above 10 lakhs, the return comes down to only 3.58%. Now let's move on to the main topic. It's a common notion that investing in stock market is risky, and people also assume that even mutual funds invest in stock market. In conservative hybrid funds, the exposure in equity is only about 25%, and the remaining 75% are invested in fixed income securities, which are not sensitive to movements in the market. Since part of these funds are invested in equity, they do benefit when the stock market performs well. In the next slide, we'll have a look at some of the hybrid funds and their actual return in past 3 years. On screen, you can see 7 hybrid funds which have given actual average CAGR of 10.97%. Since there has been rate reductions in past 2 years, but its notional effect on the return is 2% only. So even after the reduction, the average return comes to 8.97%. Also considering the long-term capital gain and the benefit of indexation, the effective tax rate is about 5%. Hence, the post-tax return comes to around 8.52%, which is much higher than the FDR returns. On screen, you can see the comparison between hybrid funds and fixed deposits. Post-tax return of FDR is 3.58%, while that of hybrid funds is 8.52%. which is almost double than FDR. Moving on, we'll now have a look at dynamic balance fund. These are the type of funds that varies its exposure in debt and equity from 35 to 65% depending on the market situation. The exposure in equity increases if the market goes down and the investment in debt security is reduced. Similarly, if the market goes up, the investment in equity decreases and the exposure in debt increases. Now let's have a look at performance of these funds. On screen, you can see that in the past 3 years, the average return is 13.32%. Giving the notional effect of rate reduction of 2%, the average return stands at 11.32%. These funds are treated as equity and are taxed as long-term capital gains at the rate of 10%, which gives us post-tax return of 10.19%. On screen, you can see the comparison between FDR and dynamic balance funds. Pre-tax return of FDR is 5.12% and that of dynamic balance fund is 11.32%. Post-tax return of FDR is 3.52% and that of dynamic fund is 10.19%. These funds are riskier as they have average of 50% invested in equity compared to conservative hybrid funds, but the returns are rewarding. Here we have comparison for last 3 years, but even if we look at the returns of past 10 years, returns are higher than the FDR. I haven't discussed and compared other aggressive hybrid funds with FDR as they have 75 to 85% investment in equity, which makes them much riskier than fixed deposits. Now let's have a look at overall advantages. Even if FDR doesn't mature, the interest earned each year is taxed, whereas mutual funds are taxed only on redemption. Even benefit of indexation is available for long-term capital gains, which reduces your effective tax rate significantly. As we have seen in charts, the returns are much higher compared to the fixed deposits. Day-to-day NAV is declared for mutual funds online and the redemption amount can be received within 1 to 2 days, while premature redemption of fixed deposits results in interest loss. There is no lock-in period for mutual funds. Easy exits are available based on the NAV of the respective mutual funds, so the investor can choose to redeem the investment after earning a good return as well. But if the fixed deposits are prematurely withdrawn, the interest on it is lost. Give us a thumbs up if you think this video brought you a little clarity and a step closer to your investment goal. The aim of this channel is to educate the investor so they can make better and informed choices with their money. Subscribe to the channel for more such videos in the future, and I will see you next time.